In this video, we will be taking a closer look at Lockheed Martin's dividend safety. Let's first start by talking about Lockheed Martin's business model. Lockheed Martin is an aerospace and defense company. The company was founded in 1961. Since then, has grown to be among the world's premier aerospace defense companies. Lockheed Martin produces military aircraft, military and commercial helicopters, missile systems and related products, military ship, and military as well as commercial satellites and space systems. Lockheed Martin has 105,000 employees, trades with a market capitalization of $87 billion, and generates annual revenues of more than $50 billion. Lockheed Martin is a dividend growth stock that is well known among retail investors. Lockheed Martin has increased its annual payout every year since 2002, but there were several dividend reductions between 1999 and 2001. Lockheed Martin therefore does not qualify as a dividend aristocrat or a dividend king, but with more than 10 years of annual dividend increases in a row, Lockheed Martin qualifies as a dividend contender. If the company is able to maintain its dividend growth track record for the next couple of years, it will turn into a dividend aristocrat during the 2020s. Lockheed Martin offers a dividend yield of 2.8% right here, which is well above the broad market yield, but not in a territory where investors usually start to worry about the safety of the dividend. In this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. We will be looking at Lockheed Martin's dividend safety relative to the earnings that the company generates in the first part of this video. Lockheed Martin announced its fourth quarter and full year earning results on January 29th. The company reported it generated earnings per share of $17.59 during the fiscal year. Lockheed Martin pays out $8.80 in dividends per year, which means that Lockheed Martin's dividend payout ratio is 50%. Overall, Lockheed Martin's dividend looks very safe relative to the net profit generated by the company today. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Lockheed Martin's current dividend payment to its free cash flow. During fiscal 2018, Lockheed Martin has generated operating cash flows of $3.1 billion, but this includes a pension distribution of $5 billion that will not occur next year. Adjusted operating cash flows thus would have been $8.1 billion, with capital expenditures totaling $1.3 billion during fiscal 2018. Lockheed Martin would have generated free cash flows of $6.8 billion, excluding the pension contribution. The company distributes $2.3 billion of common share dividends a year for a free cash flow dividend payout ratio of 34%. Using free cash flow, our conclusion is the same as when we used earnings to measure Lockheed Martin's dividend safety. The company's dividend appears quite safe for the foreseeable future. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Lockheed Martin's current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Lockheed Martin's performance during this time period is shown here. Lockheed Martin's earnings per share declined by 8% peak to trough during the last recession. More importantly, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. Accordingly, We have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Lockheed Martin's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. During fiscal 2018, Lockheed Martin generated $668 million of interest expense and had $14.1 billion of debt outstanding for a weighted average interest rate of 4.7%. The following image shows how changes to Lockheed Martin's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Lockheed Martin's weighted average interest rate would need to rise well above the 30% level before its dividend would no longer be covered by free cash flows. Accordingly, we believe that Lockheed Martin's debt level is very unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Lockheed Martin's dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.